Recently, American economist Harry Dent spooked a lot of Australians when he predicted an economic tsunami that would take property prices way back to the levels we haven't seen for over a decade. Now, others say our resources boom and housing shortage will ensure property values keep doubling every decade. Who's right? I'm Michael Yardney, and I'd like to spend a couple of moments speaking to you about why economists get things so wrong. You see, it's easy to sound smart in a property boom. You know what they say, a rising tide lifts all ships. But you have to be very careful who you listen to at this stage of the property cycle, because there are some interesting challenges ahead for us. If our economists are armed with all the research available in today's information age, why can't they agree on where our property markets are heading? In fact, a better question would be, why do some get it so wrong? And before I explain that, I'd like to remind you that at the end of October, I'm going to be running my annual Real World Real Estate Workshop. It's Australia's longest running advanced property training, and it's for you if you want to move your property investment to the next level. It's not a sell fest, so you're going to get lots of information in a small classroom environment with the best faculty of property educators I could find. And it's especially for you if you're interested in getting involved in property renovations and property development. So you'll learn how to get strong cash flow from your high growth properties. If you want to know a bit more about it, click on the link below and find out all about it. So back to the original question, why do economists get it so wrong? The simple answer is that market movements are far from an exact science. Now, the fundamentals are easy to monitor. Things like population growth, supply and demand, employment levels, interest rates, affordability, inflation pressures, things like that. However, there's one overriding factor that experts have difficulty quantifying, and that's investor sentiment. In a report earlier this year, Dr. Shane Oliver, who's AMP's chief economist, explained that people often suffer from lapses of logic when investing. And he explained that many of their investment decisions are driven by emotion. For example, we tend to extrapolate the present into the future. When things are booming, we think good times are going to never end. And when the mood's down, when the market mood's glum, we have difficulty seeing light at the end of the tunnel. Think about it. When the media reports falling property prices or an impending housing crash, many investors become scared and sit on the sidelines. They believe the end of property is nigh and things will never improve, when in reality, much of the risk has been removed from the market. On the other hand, when property markets are booming and stories of investors seemingly making huge profits overnight abound, people want to jump on the bandwagon and cash in. And that's often a time when the market's near its peak. Other emotional traps include becoming overconfident, wishful thinking, and ignoring information that conflicts with your current views. In other words, many investors create their own reality. Can you see how this type of activity, influenced by investor psychology, drives booms and busts? How the dominant investor mentality of the time helps drive the property cycle? Simply, when investors put on the brakes, housing values tend to stagnate or fall due to lack of demand. And when they jump back into the market, demand rises and up go prices. Now, obviously, one or two misguided investors won't be able to influence property prices, will they? But investor sentiment is contagious. People tend to want to do what others are doing. They follow the crowd because going against the popular opinion is seen as risky. What if you make a mistake? What if others are right and you're wrong? So Shane Oliver said it's this collective behaviour that's actually magnifying things, and it occurs because of a number of things happening. For example, today mass communication enables behaviour to become infectious. Now more than ever we're bombarded with messages from the media influencing how we think and how we feel about things. When we hear that real estate's doomed, all but a handful of sophisticated investors get scared out of the game. And when the media tells us housing markets are booming, everyone wants a piece of the action. Another thing that makes us all conform is this sort of pressure to conform. If your friends and family are doing it, it must be right? Human nature makes us reluctant to do the opposite of what our peers are doing. The other thing that gets us all to do the same thing at the same time is a major precipitating event which can give rise to the general belief that motivates investors' behaviours. Think about it. The global financial crisis saw waves of investors scared out of the market. On the other hand, the resources boom enticed thousands of investors into mining towns to cash in on the resulting property boom. Another thing that suddenly gets us all to do much the same thing is a general belief that grows and spreads. When the belief that property values can only go upwards spreads through an uneducated new generation of investors, they enter the market pushing up property values even further. And I guess what that happens is they perpetuate the belief and help make it a reality. Similarly, when the crowd believes the market's going to crash, they steer clear. This gets reported in the media and the negative sentiment feeds on itself. Now, Oliver again observed that these lapses in logic by individual investors and the magnification of these lapses by crowd psychology feeds property cycles and goes a long way in explaining why we see booms and slumps at different stages of time. So when investor sentiment is positive, the crowd jumps in feet first, pushes up demand and places upward pressure on prices. That causes boom conditions, doesn't it? Conversely, when sentiment is negative, the crowd backs off and frequently sells out due to concerns about losing everything, and that causes a market slump. So what can we as investors learn from this? Firstly, property markets are not only driven by fundamentals, but also by the often irrational and erratic behaviour of an unstable crowd of other individuals. So while the long-term performance of property is influenced by the fundamentals, its short-term performance is much more affected by market sentiment. Number 2 lesson, booms never last forever, but then neither do busts. So don't be surprised when they come around and don't overact. This will help you avoid being sucked into the booms and spat out by the busts. Third lesson, treat your property investments like a business and stick to a proven strategy to take the emotions out of your investment decisions. Lesson number 4, recognise that property is a long-term investment and set up financial buffers to help you ride the property cycles. I guess I'd be suggesting you should be investing counter-cyclically. Warren Buffett once said, we attempt to be fearful when others are greedy and to be greedy only when others are fearful. This is also the investment strategy of many successful property investors. I've always been an advocate of counter-cyclical investing. I'm often sceptical of conventional wisdom. Not because the crowd's always wrong, but the crowd's always late. Now sure, it takes some courage to do the opposite of what everyone else is doing, but the result of your contrary behaviour will ultimately speak for itself. In the meantime, successful investors will take a big picture view. They'll buy more well-located properties and see the value of their property portfolio steadily increase. Now, if you really want to get ahead of the pack and make the most of the years ahead, I recommend you join me for 3 days at this year's Real World Real Estate Workshop that I'm going to be holding in October. Now, it's Australia's longest running advanced property training, and it'll be your chance to invest 3 powerful days and learn the renovation and development strategies that experienced property investors are using around Australia to manufacture capital growth and generate strong rental returns so that they can win in today's challenging property markets. So this is your chance to take your property investment to a whole new level. Click on the link below and get full details. Then please read about all the bonuses and read about my money back personal guarantee. There's a couple of early bird spots left. So when you join us, you're going to get 9 bonuses. And if you get an early bird spot, one of those bonuses is something I've never done before. It's a one-on-one strategy session with me after the workshop to make sure you implement it. In the meantime, I'm going to keep you up to date with how to take advantage of the changes happening in our property markets in future updates like this. In the meantime, have a great week. Make this a great week. This is Michael Yardney.